Hello guys, welcome to the Trading Parrot. In today's video we're going to talk about two potential setups. There's one of them that is bullish with a potential upside of almost 10,000, and there is a bearish one which we haven't confirmed yet, but I want you to be aware in case we do, which could send us back into the previous range. We're going to look into those two setups in detail, and we're going to spend as well separately some time comparing the performance of January 2024 versus the performance of January 2025. We'll do some speculation on what will happen if the end of January did the same. It's quite tempting to do that analysis because we are following the steps quite closely. Guys, if you like this type of content, make sure that you're subscribed to the Trading Parrot. I publish multiple videos a day. And if you wonder what happened yesterday we had a collaboration video with Annie from Trade, Travel and Chill. That one went to the CoinViewer Trading channel. If you missed it, and that's all I was able to do yesterday since I was still a bit ill. Today feeling a bit better, so I should resume my typical videos. Hopefully this afternoon I'm going to be able to do some live stream and cover some altcoins as usual. The last full video we made for Bitcoin got 4.7k views and 800 likes. We're just 200 likes from getting one video with over 1,000 likes, which is not something I do for vanity. The main reason is because those likes really impact the number of views that the video end up having and the growth of the channel. Okay, let's get into the content. Looking at the economic calendar, the things that are still coming up this week that people care about mostly are the inflation rate report from Japan together with their interest rate decision. There is an expectation of increasing the interest rate from 25 to 50 points, and the public is expecting that markets might get really spooked with this. And you know what I think about these events? I usually pay attention to the charts, which is precisely what we're gonna do today. This video gonna be in-depth analysis. I'm not gonna miss any of the important data that I care about. So let's go with the open interest. We are still ranging. We couldn't break above the 32.1 billion. 2 days ago, we saw another rejection from there. In my opinion, that is somehow positive. Number one, because we didn't do something like this, which we already know can produce an automatic journey back into the low area in here, reaching even 28 billion, not just once, but we did it twice. Second, after seeing that rejection from the top, the open interest remains somehow in a bullish structure with higher lows. At least we get a double top there, but this low is more or less 50% of this one in here. So just from the point of view of open interest, structurally speaking, there's nothing broken. In January, we are almost 9% up. On the weekly time frame, we are just on Thursday, so there's still some days to define the final shape of the weekly candle. As of now, we are still defending the top of the range, the second half in here. If we lose 98.3, from the weekly perspective, we enter into the bearish area. And if we did something like that, then from the weekly perspective, this is just a dead cat bounce with a likely move into the bull market support band. But of course, we are doing an analysis intra-candle. We don't know if this candle is going to complete in green by Sunday or if it's gonna even close in the red. As of now, things are looking okay. CPR analysis also important for the month of January. You can see that we have managed to test the first resistance at 104.6. We did the same in December, and the CPR model says that that makes more likely that in the month of February, we're also going to test the first resistance, which is good. At the moment, we are seeing a rejection from it. The pivots, which should act as strong support, are located between 99.5 and end at 95.4. I'm gonna switch off the CPR and compare it with 4 years ago. My most recent analysis included this week to the upside that occurred at the end of January, and we compare it with the week that went almost to 110. And just by looking at this price action in here, that rejection doesn't seem to look very similar to this one in there. The only similarities are that after the week we had a few days of indecision, indeed 3 days in here, and then we started creeping up. So far it's been 3 days and we are more or less at the base of that candle at 101. So if we were to repeat this past performance, we should be seeing a move to the upside from today or tomorrow. And that is just comparing the past performance. This is not my final analysis. Let's continue with the 4-hour analysis. On the 4-hour, we have kind of a mixed bag in here. There are some things that we're still holding, and there are some patterns that are starting to look pretty bearish as well. Just the price action in here shows somehow like an M pattern, if you want, with a neck located at 101.4. There are many wicks to the downside, and at the moment we are testing that 101.4. I have placed this line in here to measure the high from the neck, and it's pointing towards 93.3. And that is confirmed if we close a 4-hour candle below 101.4. On the 4-hour, we have been now inside this downside channel quite for a while. Indeed, from the 17th of January, we just took the lows from 46 RSI. And there are 2 levels I care coming from this channel that is still relevant. Assumption number 1, or scenario number 1, is if we break out on this channel and we start creating a channel to the upside from here. Scenario number 2 is if we go into the PNR level at RSI 30. That is more or less in confluence with the global support on the 4-hour time frame, which I'm not discarding. The top of the channel at the moment is around 50 and that support is around 30. So those levels are marked here in the reverse RSI with green. So in order to break out outside that channel and confirm some bullish potential, we need to break above 103.5. If we close below that 101.4, we start talking about the downside potential, which from the highs of this pattern, we get a bearish target, as I say, of 93.3. But the PNR says that the downside indeed is 96.5. In order to get to 93.3, we actually have to break below what the statistics are saying. And instead of stopping there, continuing to the actual bottom of the channel, which is at an RSI of 24. To be honest, we have already had quite a deep move on the RSI from 60 to 41. So I wouldn't expect it to just continue to go all the way to 24 without even testing the 50 as a resistance, in which case the lower targets are gonna change. All the targets with reverse RSI with any swing up or down will change. And remember, they do that in an inverse order. If the price goes higher, then the targets go lower. Let's keep in mind the 4-hour targets and the areas that are critical for a breakdown or a breakout to the upside. Let's park that information and let's do some analysis of the daily time frame with a particular focus on what happened in 2023 versus 2024. As you can see, in August 2023, 19th of that month was the capitulation. Since then, we built this channel to the upside and we reached for the second time an RSI almost at 90. At that point, we got 88. That happened around October. And by January 23rd, we reached an RSI of 36. From there, we have another rally into March, reaching that time an RSI of 87. So let's keep that move like this in mind. And now let's compare, instead of August 2023 into November 2023 and then January 2024, let's compare 5th of August 2024 into November 2024, and now that potential bottom information of January. There are some similarities, and that's why I'm tempted to do this side-to-side comparison in case it ended up rhyming pretty well. We can see that we have a top in here. That top corresponds with this one pretty much at the same time. This is November 13, and this one is October into November. And I'm gonna say this corresponds to this. Then this move up in there is 5th of December. This one is 18th of December. and then we get this one in early January, and this one in here, 23rd of January. In terms of price, we get a high and then a higher high. In here, we get a high and a higher high. But to be fair, I need to be comparing this with this higher high there, because those are corresponding with these two peaks that I'm using from 1 year ago. So far, those events are matching the structure. And what I mean is we get a high on RSIs, then we get diminishing values on RSI, but higher prices, giving you bearish divergences that we can even count as milestones. When it starts looking a bit different is the fact that in here we have a support at 50, and this year in January we had a support at 40. Then this support of 50 got broken, and the capitulation of January occurred on the 24th of January at an RSI of 35. Looking at this closer, if we were to do the same thing, we will have to fall from 55 RSI into this PNR, which is also the same value, 35 and 35. You can see it with the dotted line that are more or less at the same price. And if we had to do that, that is a very steep fall, 20 points of RSI from there if we lose this support that currently we are below it. And I'm sure by now you're curious to think, how low is 35 really? So let's turn on reverse RSI, and I'm just gonna keep two levels on in the settings, which is 55 and 35. 55 because that is the support from this line that we are currently potentially losing on a daily basis. The day is not finished yet, but we are currently pinching below it. At the moment, that level is 101.9. We have the point of control at 96.8, and the level of RSI 35 is 87K. So this is just a comparison with the previous year based on some similarities in the structure that are saying that if we were to have some sort of similar capitulation as last year, we should be going into 87K, where there is a confluence of an order block that hasn't been tested. We recently created one at 89, and as a result, we left the 87 one on the table. And I'm gonna share my take on this. In my opinion, the scenario of repeating this capitulation, it is a very low likely scenario. I'm not gonna rule it out. I'm not gonna tell you that it's impossible to happen. And the way I'm going to approach this is by having enough cash to enter at those levels in case we ended up seeing something like that. At this time in the cycle, I am not expecting to see something like this. So let's call it is possible, but low likely. From another point of view, the active address sentiment indicator a year ago, entering into February, was capitulating below the band, and from there it started ripping off to the upside, taking us into a new range. Network value transactions, active address sentiment indicator has already reached a similar level as the capitulation level of February in 2024 and already broken above the top of the band, which makes it less likely that we are due to see another low. And if we did get another low, it will be the lowest value of the past 2 years. Large whales continue to accumulate. That accumulation now is at 0.34. In order to get a number of 0.34, we pretty much have to go to the beginning of the bull market. That hasn't even been seen in 2023 or 2024, with the exception of just January and February 2023. As I say, beginning of bull market. We have exit extreme greed now at 75 in greed, and Cerberus continues to reset, getting closer to an area of a warning buy. Long-term holders continue to just go sideways. They sold a tiny bit at 107K. And by the way, guys, make sure that you're subscribed to the Telegram channel, my Twitter and Instagram. A couple of days ago, I published this video. We are not done yet. I published this when the price was at 101, and I was speculating that we are going to get into 107 thanks to the resistance combined from 4-hour and daily time frame. I published that together with a time-sensitive video when we were precisely at 107, making sure that you are aware and understand how relevant was that resistance. As soon as we hit 107K, we started coming down back into 101. And I hope you appreciate all that work that goes not just into the analysis and spotting these opportunities, but to update you, even to correct my mistakes sometimes, and then to poke your shoulder again once we are in that resistance. If you do appreciate it, make sure that you hit the like and write down a comment. And if you really feel happy with the content, make sure that you share this video with a friend or in your own social network. That will be really great. Okay, let's go with what's next, which is liquidation levels. And guess what? After we saw the rejection at 107, some people started thinking maybe it's a good time to sell. I would have said the short would have been better right from 107 because that was resistance, but they realized late that 107 was resistance and they enter actually at 104. In the short-term liquidity, there is some attractive level here. There's a spike of liquidity at 98.6, but of course 88 has been always the largest remaining, at least in the short term. In the longer term, things flip upside down, showing the top end still being the most attractive. Now we are 11K away from hitting red at the top, and we are 13.8 away from hitting red at the bottom at 87.6. And I think as well, guys, that we're getting very close to an opportunity again to the upside, and that is the one I was referring in the beginning of the video. And this is one that probably not many people are going to spot, and it's got quite an elevated level of risk. We are once again trading against some bearish patterns considering a long. The last time was the Head and Shoulders that we entered at 91 with some additional orders at 88. And now we have this M pattern in there. And the reason is because the funding rates are starting to test the negative area. I already got some notifications on my email, and those, you know how powerful it can turn as a long signal, particularly when there is confluence with other things. And I'm not talking about a new all-time high, but another potential swing long similar to the one we shared a couple of days ago. Let's be ready for that. I'm seeing once again that the bidding is increasing, same as the funding rate, still not negative, but getting very close to that sweet spot where we could enter in a long. The last time was in here that it got green and we had the rally into 107. Notice that my thresholds on the upside are still working. The ask in here got too high, reaching our level of resistance. Let's show that. It pinched that level in there and saw an immediate resistance. Actually, I didn't see this indicator when I was calling for 107. I just did it purely with RSI. If I saw it with this indicator, it would have been additional confidence, but I was just using my iPhone at that time. We are very close to get into the green. This just needs to go a little bit higher, maybe 1 or 2 more points, and we could start seeing some green there, which together with a negative funding fee could be very positive. The delta is in the negative, putting the shorts at risk with 200K. That's another short-term bullish signal for a short-term swing. And the 110K selling area is still there with 132 million. That is resistance, at least psychologically speaking. Something else to add to this high risk potential long opportunity is that we are at this middle range support, and I call it middle range because since 30th of December we are not going to the bottom of the range like we normally do. For example, look, the past performance is usually an extended move up and then down, up and down into a channel. The channel was going up, then going down. And since this high here on the 21st of December, instead of forming a channel wide, we are forming a channel very narrow. And that makes the risk higher because this could pinch that and go for the first time to the bottom of the range. And that should bring some downside on the price, getting us all in a drawdown if we enter close to the prices where we are. It is an opportunity because this could play like a neck, but the price might fake out there and continue going higher, trapping shorts there, and then doing again a swing into the top of here. And that's why I think there is an opportunity for that. Things happen very quickly. If funding rates go negative there, if the bidding enters into the green area I was showing you in this chart and in this chart, then we could see some upside into the resistance of the 4 hour, getting up to 103.5, 104K. We got a level of liquidation at 105.5. That is quite small, and indeed there's a lot of motivation to continue lower, making this a quite risky move. At 109.5, there is the largest liquidation in the past 30 days. You can tell that nothing even comes close. So the reward of this trade is that this scenario in here where there's so many liquidations to the downside, if someone big enters, it could take the price back up into 110. And just by having a small position there, you can take advantage of that. But of course, you need to be prepared for that downside with additional cash to enter at the lower prices. Let's look at the fair value gaps. We got this one at 96K. If you remember, I was talking about some targets around here in the analysis on the 4 hour. We have 92.5, which coincides with the target of the high of this. I'm gonna do it again just so you can see it. But the one that probably no one is seeing is the potential to go back into 110K and take everyone by surprise. Again, it's a very risky long setup at the moment, and I'm only mentioning it because I'm starting to see a little bit more fear in the market, and I love finding these setups when everybody starts to doubt. Those setups are very cool. They play out 90% of the time. But there is a 10% of the time that they go against you, and at that point is where you have to have a risk management plan, which is you take the loss with a stop loss, you define your risk, you define where you are invalidated, or plan B, you have additional cash that enters at another area of high likelihood to bounce back up, and at that point you need to have more volume than the initial deal so you can enter in that dead cat bounce and get out of it still in profit. I'm just gonna cover very quickly the recent signals of leverage squeeze that I published on Twitter. I know some people were saying that they are wrong. What I do to do the analysis is I do an average of the two signals, assuming that they were traded as if there was two DCA orders. That will give you an average more or less at 103.7, and at the moment you will be in profit. We need to wait longer to really say that they're successful. So far, the average has moved just 4% into the profits. The previous signals did 8%, 13%, and this one almost 15%. So that will leave this 4% as the worst out of the past 4 signals. Something new I'm monitoring is this potential new injection of cash on China. These candles are all over the place. Data is constantly updating on TradingView. They take at least 1 week to settle. So this is just an early heads up to potentially see additional liquidity coming in. The global M2 liquidity has printed another candle. The last one we were saying, finally we have one to the upside, but it was so small that you need a magnifier glass to see it really. But this second one is luckily a bit more substantial, getting us a bit higher. I'm going to connect the RSI with the global M2 and see how does that look. So from a high of 81, then it bottomed at 41. And it's not just breaking above this trend line, which doesn't really have any pivots to connect to, but is above the average now. So hopefully it's going to take us somewhere and it's going to continue that trend into the upside. The global M2 resuming injecting liquidity into global markets together with China, and hopefully this double bottom formation on the balance sheet of the Federal Reserve are just very early, mild signals of additional flows coming into the macroeconomy, which are a must-have to even talk about a decent altcoin season and retail coming back. The weekly analysis unfortunately doesn't really look good. even for Bitcoin, because we are back below the yellow line. It is still resistance. Stochastic RSI at the moment discards a bullish cross in the middle of the range. And this yellow line in there at 69 RSI at the moment is resistance for the price for a second consecutive week, assuming that we close the week below 103.5. Above 103.5, then things can turn bullish back into the weekly basis for Bitcoin. Guys, if you want to trade Bitcoin on a top-notch exchange, I have two alternatives. My preference will be to have both of them, deposit a bit on Bybit and a bit on OKX, and then get access to all the different altcoins and products that these two top exchanges can offer. Bybit offers 30,000 in rewards, OKX 60,000. And by using the links in the description, you can claim as well discounts on trading fees. If you need to use an exchange that doesn't require KYC, then I have also two options. The first one is Bluffin, second one is 2bit. Either of them are offering great rewards. At the moment, Bluffin is even offering a Rolex, MacBook Pros, iPhones, Nintendo Switch, all of this based on trading volume. Same with 2bit, up to 30,000 in rewards, in this case based on deposit and trading volume. The beauty of using a non-KYC is that, well, you don't have to go through the hassle. You shouldn't have issues with withdrawing and depositing crypto, being able to create multiple accounts with different emails and then split your different strategies, your risks, and of course, not needing to use a VPN. Have a look at the link in the description. All the links offer the lowest fees to trade. See you in the next one. Bye bye.